Trading Market Technicals morning call video for Wednesday, December the 4th. Well, we got that little bit of a push to the downside. Dow Jones down 94, Nasdaq down 8, S&P down 575, and Russell down 5 3/4. A little bit of a push down, a little bit of continued selling, something refreshing that we'd like to see. Now, does the market continue? That's going to be really the big factor here. We had 3 days down, nothing really big to write home about, but does the market continue to sell off here? We're still grossly overbought. So this is an opportunity for the bears here to really push this market lower. 1792, we did break that key level in the E-minis of 1797. I'll show that to you in the chart segment. However, we're still chopping around here. This is going to really be the factor. If we can't break this 1792-ish, 1794 area, right in this little zone, about 5 handles, I think we actually get a chance to bounce one more time. And that's quite possible, especially as we get closer to the Christmas holiday. There's going to be less people, less traders in the market, where we might just be able to be chopping around in a certain area in some sort of a zone. So that's something that we're going to need to follow. However, we do have our indicators showing us some really deterioration in this trend to move higher. I'm going to show that to you right now. We could just see here the New York Stock Exchange new 52-week highs. We cannot break out of this slanted downtrend line. We've actually making lower lows and lower highs, and yesterday we just literally just dumped that, fell right out of bed here. So this is something that's a concern, and again, I keep pointing this out. Not that I'm telling everybody to go short the market. I just want you to be aware that the market can roll over. And when I mean market, let's take the S&P as a proxy here. We can obviously could be the IWMs, the Qs for that matter, transports. But we want to really pay attention here because if you are holding positions, swing trading anywhere from 1 to 3 days a week, or if you have you're a long-term investor, you need to know this so you can be prepared. So if the market does open lower, you're not going to be in shock about it. So that's really important. Day trading, obviously, is a different story. But even day trading, markets can roll over at any given time when you're at these lofty levels and you're starting to deteriorate here in a trend. And the breadth of the market itself is not healthy as well. So we have the New York Stock Exchange new 52-week highs breaking down. We also have stocks, the new lows. We still haven't broken out of this area, but remember, I keep showing you this because it's going to be a nice indicator to watch when we do start to break out here. We are making higher highs and high lows in our stochastics. We are above the mean here in our MACD, so everything's pointing for higher prices on this indicator, New York 52-week lows. So as the highs are breaking down, the new lows are coming to the upside. Again, not what you want to see. New York Stock Exchange, New York Stock Exchange new 52-week highs and lows starting to break down here, as you can see. So you can see by the 3 indicators here pointing to the bear camp. So use caution. Tick as well, breaking down now below 0 again, as you can see, making lower highs and lower lows. We're below the 0 line, and if we continue to stay below 0 on the tick, that's just telling you again another indication that the breadth of the market is starting to deteriorate here. Okay, so it's something really to be cautious about. So not looking to buy high flyers here, not looking to buy breakouts, because as the indicators and the breadth saying that we are weakening, the last thing you want to do is start buying a breakout or start playing breakout plays. That's something that you don't want to be doing. If anything, look for strong stocks to buy on pullbacks onto some good support, and hopefully that you get a nice bounce on these on this market play, or look in a short relative weakness to what the market is doing. That's probably your best bet. VIX. We do have a black candle, possible reversal, so that's actually a good sign for the market. We did bust out of this here. You can see the Bollinger Bands here would tighten, so we had a little bit of energy building. MACD and stochastic showing positive divergence as the VIX was moving lower. Caught that, again, long-term support of 2013, and then we bounce here. So where do we go from here? Possibly, I would say, a pullback, maybe a back test of this area here, and then resumption of the trend to the upside, which would give pressure to equities again as well. Now, interesting development. Before I go into crude oil, I just want to show you the banks. Now, banks actually are pulling back, which is great. That's exactly what you want to see. We had this breakout, failed breakout, but we did break out of this ascending triangle. As you can see here, we're really overboard here. I like to see the stochastic come back right into that 50 line, as well as the MACD, and then that would be a good buy indication. We're sitting on the 20 now. Maybe we breach the 20 a little bit, take this trend line up a little bit, and that will coincide nicely with the 20-day moving average. Now, why do I show you the banks? Because as you know, I do like the three banks here, JP Morgan, Citibank, and Goldman Sachs, but now they're overextended. They did pull back yesterday, which is a good sign. I'd like to see a little bit more of a further, deeper downside correction in the banks before we get involved on a long side. Now, the XLF and the bullish percent ENER, bullish percent financials, excuse me, that needs to, sitting right here. Now, this could actually turn as a sell or break to new highs again. Now, at these areas here, as you can see, we usually have some sort of a sell-off here, and I'm looking for a push lower so we can get down a little bit of a deeper downside correction again, maybe to like the 2075 area in the XLF, and then resumption of the uptrend. Okay, now let's take a look at WTI. Perfect setup. We're at the 20-day lows, as I mentioned. We needed to break out of this 95 area. We really broke out with force here on this push higher. We had positive divergence, like I was showing you. And again, you could have easily taken this trade. Below this area would be your stops, easy to manage, or to confirm it so we could break this bearish symmetry of lower lows and lower highs. As you can see here, lower low, lower high, lower low. Now we broke out of this, and I'll show this to you on the USO. I like to be playing any type of pullback here. Would be a great move. Now remember, we still have confluence area of resistance, the 15 to 20. I'm sorry, the 15 to 200, which is the golden death cross to the downside. So this also is a little bit of a concern. But if this retracement rally is for real, we can have a deeper upside correction, possibly to the 100 area, and then we would reevaluate. But again, this here is going to be a big hurdle to overcome, which would be the 15 to 200-day moving average, coming in right around 97.87 to 98.43. But if you can get a pullback here, that's going to be a nice upside target, at least 2 or 3 points here to the upside. All right, so let's take a look at the charts. Here is the E-mini S&P daily chart. As you can see, we made 2 extensions already to the upside, and that was sitting on the 20-day moving average. I like to see the market come in anywhere around the 1770. Remember, 1792 is going to be the next little small target area, and then of course 1786 would be your next one, next little support area. So 1786, right up in this area here. And that would just be above the 1.618% retracement. I'd like to see, again, guys, I'd like to see us get back down to the at least 1760 area. Even the 1740-ish would be ideal before we resume the uptrend. Possibly, if we can get down to that area in the next, 3 to 7 trading days, that would be a great opportunity to buy some stocks going into the end of the year and possibly moving higher into the first of the 2014 season. But again, we're still overextended here. But if we can't break this area, if this area cannot break the 1.618% retracement, 1780 or 1777, call it if you will, then I think you're going to have at least one more shot to challenge the highs of 1812. Okay, here's the spiders just to show you 3 days down, 3 days down, 3 days down. This year, 3 days down, 4 or 5 days down. So you can see the symmetry is very similar. Now we're at the 20-day moving average, 3 days down here, same scenario. Do we rally now? That's going to be the thing. We're up about 2.25 handles in the real early morning here, about 3:18 a.m. in East Coast. So let's see if this small gain in a pre-market electronic session in the E-minis can hold. But we are now sitting here at the 20-day moving average. So a good spot for a bounce. I wouldn't doubt if we do get a small little bounce here, maybe back to the 8. But the 180-ish, 181 area, if that's going to be a back test, maybe a small bear flag and then fail again, I would love to see the market come into about 175, 174, or at least to the 50-day moving average. That would be a good spot for testing some long trades. Here's the diamonds. Again, same thing. As you can see here, really extended, nice uptrend channel from this area here, from the October 9th low, And as you can see here, now we're just kind of hugging along here, chugging along to the upside. We do have the Bollinger Band starting to tighten here. Energy starting to build, but you can see we're really overbought still in this in the Dow Jones as well. But we did break the upside channel. Let's see if we can get a deeper downside correction, at least to the 156 area. Again, healthy for it to correct. Even if it's a 2, 3, 4% correction, I think would be ideal. Now remember, everything doesn't go straight up, straight down, especially to the downside. We've only had 2 to 3 day pullbacks and the market would resume its uptrend. So let's see if that's still to happen. Transportation sector, obviously going to have a little bit of weakness. Watch crude oil if you do trade that. Actually, crude oil is up $1.12 in the electronic session, early morning session as well. So we have some continued buying in crude oil. And this thing here sitting at the 20-day moving average possibly breaks. If crude oil continues its march higher, then you're going to have weakness in transports, which could easily help the market sell off as well. So you got to keep an eye on those transports no matter what, even if you trade them or you don't trade them. Definitely a good indicator to follow intraday, a good sector to follow, excuse me. Russell, good gauge of risk. We caught the uptrend of the 2012 lows, and now we're back at the 20. So you can see pattern recognition here. We rolled over. Most of the 5 sectors that we follow have hit the 200, the 20-day moving average. And now this is going to be a logical spot for a bounce. Does it bounce and fail? That's what happens. If we fail and we take out yesterday's low, then I see a deeper downside correction to at least a 50-day moving average. Okay, that's what I'm going to be looking for today. I'm going to be looking for any type of weakness, and if the weakness does happen, we want to see. Remember, I pointed out selling coming in towards the end of the day, anywhere between 2 to 4 o'clock. Let's see if that selling resumes today, or if it's exhausted already. Now we've had that for the past 4 or 5 trading days, but I want to see if this if that continues. If not, and we do rally, we could actually be resuming the uptrend. Because remember, if this spot holds in the 5 sectors here, it holds that 20-day, then it's going to be a logical spot for a bounce and possibly challenge the highs again. XLF, just wanted to show you that again. 20-day moving average, good spot for a bounce again. And you know, we're overbought. We're still overbought. Not a sell signal, but not that you want to get so excited here about looking to buy these sectors here. And if you can see, I show you Goldman Sachs. We hit our target of 170 easily. Took a little time, but I like this. I still like Goldman on a deeper pullback here, maybe to the 50-day moving average. Be patient, because these stocks will set up again. And if you know, you want to get a good entry, because if the market does roll over and you're long, at least you're not going to get hurt. But if you start buying here at these highs and the market rolls over, it's just not going to be pretty. At JP Morgan, as you can see here. Now, JP Morgan pulled back close to the 20-day moving average. I, again, would like to see it at least get into this gap area of support, and which would coincide nicely. Even if it tested the 20-day moving average, maybe another 60, 70 cents in JP Morgan, I'd be looking to buy some of the banks here again. I do like JP Morgan, Goldman, and Citibank. Those are my top 3 favorites. And as you can see here, we have the IGN networking sector really not doing much. We do have that bearish pattern of the head and shoulders pattern still valid, but still kind of just hovering around this neckline here. So it's going to really need to get going to the downside. We've got to start getting away from this area here. And we have Apple. Apple now hit its target. So we had a nice big move up in Apple. Again, any pullback in Apple to the 530, 540 area would be another good spot to buy in. I wouldn't chase Apple here. Apple's already extended. And that's exactly what happened here when you were starting to build energy. You can see the Bollinger Bands pinching, starting to build energy, and all of a sudden, boom, you get that one big move to the outside. And that's why I said to you before, I don't really trade Apple, but when I mentioned wherever it breaks, that's the trend you want to follow. And sure enough, it broke out that day. You could have easily gotten in that day, and it started breaking to the upside and following Apple here. Now Apple's extended, and in all due course here, looking for a pullback in Apple to possibly get in. And lastly is the Qs, as you can see here, way extended as well, looking for a pullback into at least the 20-day moving average. Okay, guys, that's really about it. Let's see if the market can muster a little bit of a bounce. And if the market bounces and fails somewhere, anywhere in, let's talk the E-minis here, the ES. If the market can bounce and fail anywhere from the 1798 to the 1800, 1802 area, start to fail, and we get some sort of a trigger to the downside, I'd be looking to short that. If the market can rally and take out and get back above the 1802 area and hold, then I think you have a shot for the resumption of the uptrend, at least to test the highs of 1812. And this is the E-mini S&P we're talking about here, okay? So the plan today would be to 1797, 1802, fail, look to reshort, enter short the market. And if the market can break back above the 1800, 1802 area, then we'd be looking to buy pullbacks again. So let's just see what happens here. Be selective in your trades as the market gets closer to Christmas. As you know, market participants start to fade, and you're going to have whippy price action because there's going to be less volume here to really support that move when it does happen. All right, have a great day. We'll speak to you tomorrow. Take care.